Fundsupermart.com.
Hi Sanjiv. The Indian equity market has had a rather volatile year in 2012. Do you think the volatility will continue into 2013, and what is your outlook for the Indian equity market over the next 2 to 3 years?
Sure, you're right. Last year, 2012 was quite a choppy market. India did very well in the beginning of the year, and then things drifted down. The reason in the beginning of the year, people were expecting quite a lot from the government, but nothing quite happened in the first couple of months of last year. And then the market gave way. Finally, in September, the government surprised the stock market by announcing a host of measures, which surprised the market, and the market then rallied up again. So overall, the market ended up 24% in US dollar terms, so pretty strong performance. Going into 2013, it'll be a similar sort of story. A lot of people still don't believe the government, even though the government has delivered quite a lot, and we think they've taken some really difficult decisions. So a lot of people still don't believe the government. Even this year, in the first few weeks, the government has taken some more steps, and we think on the back of that, the market should move up. But there are a lot of events that are coming up. Early next year, there's an election by May next year. So that'll be a key factor. We've got a budget at the end of February. The market is expecting an interest rate cut at the end of January this year. So there are a lot of events that people will be looking at. But the key one will be if the government keeps delivering. Surprisingly, just to wrap up the last point, Indian earnings are very smooth. So last year, the year before last, Indian earnings grow 10 to 15% per year. And it's one of the smoothest in the world, smoother than Singapore, US, Germany. But the market tends to yo-yo. But earnings is remarkably smooth.
India has continued to see very high inflation rates. Do you see this affecting the Indian equity market?
Sure, it has had an impact. So inflation has been high. We recently had a 3-year low number, but it was 7%. So even though it's the lowest in 3 years, it's still running at 7%. I think the market is now looking at inflation being stable. It used to be above 10% for most of 2011 and part of 2012. So we've seen it coming down. The central bank is also looking at inflation coming down. On the back of that, we're looking at interest rates being cut. So we're looking at over 100 basis points of interest rate cuts in India, starting at the end of January 2013.
How did the fund perform in 2012, and what were the main drivers and detractors from performance?
Sure, we had a good year last year. So the fund did about 40% in US dollar terms. The market is up about 24%. So for us, a lot of our key holdings did very well. So a company, Maruti Suzuki, a car company, performed very strongly. HCL Technology outperformed the market. United Spirits, it's a big spirit company. That company agreed a takeover deal with Diageo. So that company went up 4 times. So we saw a lot of our key holdings performing quite strongly. At a sector level, overweights in cyclical sectors helped us. So our position in the technology sector added a lot of value for us, for the fund, for our investors. Consumer discretionary, which is the car names, industrials, pretty much across the board. I think every single sector added value to the fund. So we got both our sector allocation and the stock picking within the sectors correct.
Which sectors do you see the most and least opportunities at the moment?
Yeah, I think it's a similar sort of story. So we're seeing signs of the economy starting to bottom. So we expect GDP growth to pick up. So that'll help cyclical sectors. We're looking at interest rate cuts starting in India. That'll again help the cyclical sectors. And thirdly, cyclical sectors are still trading at very cheap valuations relative to defensive sectors. So the sectors we like again are industrials, financials, technology, materials. So a lot of the cyclical sectors is where we are positioned as we go forward for 2013 as well.
Thank you.